In 2008, the smartest investors on Wall Street placed a public bet against the simplest investment strategy imaginable. 10 years later, they lost. Not just lost, got demolished. And the guy who beat them spent roughly 0 hours analyzing stocks to do it. I'll show you exactly how that bet played out, and more importantly, why the same thing has been happening for over 90 years. By the end of this video, you'll understand the one mathematical reason that almost guarantees index funds will keep winning, and why most professional money managers pray you never learn this. Let's go back to where the story starts. 1928. A guy named Edgar Lawrence Smith published a book that accidentally invented something called the mutual fund. His idea was simple: pool regular people's money together so they could own a slice of many companies instead of gambling on just one. Sounds smart, right? Here's what nobody expected. Over the next several decades, study after study kept showing the same embarrassing result. The professionals running these funds, people with Ivy League degrees, armies of analysts, and Bloomberg terminals that cost more than your car, they couldn't beat a simple market average. By 1975, a guy named John Bogle had seen enough data to make what everyone thought was a completely insane decision. He created the first index fund available to regular investors. Not a fund that tried to pick winners, a fund that just bought everything. Every stock in the index, no thinking required. The financial industry laughed at him. They called it Bogle's folly. Wall Street executives said nobody would want average returns on purpose. But Bogle knew something they didn't. He understood the math of costs. See, every time an active fund manager buys or sells a stock, there's a cost. Every time they pay their analysts, there's a cost. Every time they rent office space in Manhattan, there's a cost. All those costs get taken out of your returns before you see a single penny. The average actively managed fund charges about 0.68% in fees per year. Doesn't sound like much? Let me show you what that actually means. Let's say you invest $10,000 and the market returns 10% a year. In an index fund charging 0.03%, after 30 years you'd have about $174,000. In that same market, but paying 0.68% in fees plus trading costs plus taxes from all that buying and selling, you'd end up with roughly $138,000. That $36,000 difference didn't vanish. It went to Wall Street, and that's if your active manager matches the market, which statistically they probably won't. Here's the data. Every year, S&P Dow Jones Indices publishes something called the SPIVA scorecard. It tracks how many professional fund managers actually beat their benchmark index over different time periods. Ready? Over 1 year, about 60% of active managers underperform. Over 5 years, it's about 75%. Over 15 years, 92% of actively managed mutual funds fail to beat a simple index fund. Which brings us back to that bet. In 2008, Warren Buffett bet a hedge fund manager named Ted Seides $1 million that a simple S&P 500 index fund would beat a portfolio of hedge funds over 10 years. Seides selected 5 funds of hedge funds. These were vehicles that spread money across dozens of top-tier hedge funds. We're talking about the cream of the Wall Street crop. The index fund returned 125.8% over those 10 years. The hedge fund portfolio, just 36.3%. It wasn't even close. So why does this keep happening? Why do the smartest people with the most resources consistently lose to an algorithm that just buys and holds everything? 3 reasons. First, the cost problem we already covered. Fees compound just like returns do, except they compound against you. Second, the paradox of skill. When everyone analyzing stocks is brilliant, being brilliant isn't enough anymore. It's like playing poker against 9 other professionals. The game becomes so competitive that luck dominates outcomes in the short term and costs determine the long term. Third, and this one surprises people, active managers actually have to beat the market before fees, not just match it, beat it by enough to cover their enormous costs. That means they need to find mispriced stocks, trade on them correctly, and do it consistently enough to overcome a 1 to 2% total cost disadvantage every single year. So what does this mean for you, sitting here with money to invest? It means you have access to the same strategy that's beaten 90% of professionals for nearly a century. You don't need to research companies. You don't need to read earnings reports. You don't need to guess which sector will win next quarter. You can buy a total market or S&P 500 index fund for almost zero cost, hold it for decades, and mathematically, you'll beat almost everyone trying to outsmart the market. The greatest investing strategy isn't complicated, it's boring, and that's exactly why it works. If you found this helpful, there's a video on your screen right now about the 3 index funds that cover almost everything you'd ever need to own. It walks through exactly how to build a simple portfolio in about 10 minutes. No Wall Street degree required.